Good afternoon, everybody, and welcome to Gary's Traders Group. This is your host, Gary Humeski. It is Monday, January the 12th, a few minutes after 4 p.m. Eastern Standard Time. I want to welcome everybody on board, new as well as old, and let's get right into it and get through the disclaimer. These webinars are for educational purposes only. I am not giving any trading advice or telling you to buy, sell, or trade anything. Okay, that done. Boy, look at that market again. It just doesn't like what's going on out there, but I'll tell you what, oil is $45.97. That's pretty low, guys. I think they're all saying $40 a barrel is around the corner. Going to put a lot of the shale companies out of business, or at least have them cut production tremendously, as well as a lot of investment banks. They're going to pull out some of their funding if this continues. So we're going to hurt, and I think this was a clandestine plan by OPEC because they can weather the storm and make us go back and be dependent upon them for our oil. I don't know. That may be just my opinion, but let's get through the. Got a lot of stuff to go through. The macro picture. We seem to have some capitulation is what I'm seeing happening over the last 2-3 weeks. We've had bull days, bear days, and that's what we call capitulation of not a definitive direction yet in the market. I think you can see here on the Dow Jones, we do have an upturned hull on all three indices, it looks like. And the hull is very, very accurate. I think those of you who've got my workstation, by the way, if any of you'd like to have a duplicate of my workstation, just email me. Thinkorswim now has the ability to share workspaces, which is really cool. I think I remember seeing it, but it was brought to my attention again by one of our members, and I shared the workspace with him, as well as another member, Tom, I believe, I shared with as well. So if anybody else is interested in this setup, just email me and I'll be glad to get it to them. Once again, hull turned over on all three indices, from the NASDAQ to the S&P to the Dow Jones. We have capitulation, but we have a major trigger, which is the PPS. And inevitably, when the PPS triggers, the MOBO triggers afterwards. Like you can see here, the PPS triggered on the S&P, and then the MOBO triggered, which created the downturn in the market. So we have two positive signs that this market's looking to turn back around and head up. So that's what I see on the big charts. Let's see what the fear index says. Well, again, some capitulation, up, down, up. We do have the trigger for it to go down. It looked like it tested to bust through the MOBO. It is starting to consolidate a little bit, and if anybody's familiar with Bollinger Bands, when they consolidate, that usually tends to mean a change of direction. And this is again versus the SPYs, the ETF, and we do have a trigger to pull up on the S&P, and we have a trigger to pull down on the VIX. So again, that's my assessment for the long term of what's going to be happening. All right, let's go to what's happening this week in the governmental news. Today was pretty much nothing but some auctions. Tomorrow as well, nothing really important. But retail sales report comes out, kind of will tell us how the Christmas holidays went for all the retailers on Wednesday. And then on Thursday we have jobless claims and the Philly Fed survey. On Friday, the CPI and the consumer sentiment. Oh, we also have the PPI, the Producers Price Index, coming out. So these Thursday will be a day that market will be looking at to say, hey, how's the economy churning, and are we making headway, or do the Feds do we have some inflation coming in? Are we still in a deflationary situation? Do the Feds have to come in and start raising rates? So all of these kind of governmental news that will affect the market, so be aware. Thursday's kind of a big day. All right, so that's the short-term picture. One of the things, folks, I want you to know that I've been doing lately is I've been doing a lot of studying since the first of the year. I'm always trying to improve my trading. And one of the, I think, major, I don't want to say epiphanies, I've always known it. I just really haven't followed it because I'm pretty loyal to best choice, and seasonality I do believe in is a great tool. But I also know that if you look at, all of the option traders, majority of them are net sellers. They're selling options. And those are the people really that are making consistent money in the market. So I've done some research. I've joined a couple of different outfits to help me that are giving me tutorials and so forth. This all kind of spurred from the fact that I'm realizing, my win-loss ratio is not where I want it to be. I'm making money, but not as much as I could, and I could be more effective and consistent in my approach. So I'm going to start introducing more alternative strategies to take in money, get paid for trading, as Scott Macbeth had suggested. I'll still talk about directional trades. I'll still enter them, but I'm going to spend more time on showing some alternative strategies as well. Also, one of our members has asked to, I'm going to address a couple of questions. There's two questions that were posed to me. One is to look a little bit more at some calendar spreads, of which I'm starting to do. I'm going to look for alternative methods of finding good candidates for calendar spreads rather than the only technique I know right now is using best choice. And using specific setup conditions from the wizard, which are very, very easy to look at. If anybody else wants to duplicate this, just add the primary basic conditions. It'll default to average volume. You want to bring that up to about 500,000. And then you want to bring your stock price up. I generally put it to about $30. And then there are two other conditions you want to add to be able to find candidates for good calendar spreads. One is you want to have earnings screaming through the roof. So you want to look at earnings growth rate for 1 year. I really want to use one because I want to catch that company as it's making a lot of money, not 2 years. 2 years means it may have already had its run, and I'm catching the wave, towards the end of its run, and I don't want to do that because calendars is playing the time value game instead of the intrinsic value game, and those are the only two games you can play in trading options. So you add the earnings growth rate, and I will bring this thing up to a very, very high level, folks. You'll watch how this drops the number of securities. I like to bring it up to almost 80% growth rate. 79. You can see it went from 892 stocks down to 107. The next criteria, though, is you want narrow linear regression bands. So you want to have price consistency. You don't want volatility where it's all over the place with wide bands. So you want to look at price growth consistency 1 year and add that. Also, I'm bringing this up to a very high consistency, so I create a scenario where there's only narrow bands, very narrow bands. So I'm going to bring it up to about an 80 as well, 79, 79.35. That gave me 47 candidates. This is what I did yesterday, the 11th, and I created, ended up with 42, so today's numbers are a little bit different. I ended up with 42 candidates, of which I went through all of them. And again, this is predicated based on best choices, annualized earnings input. As we know, some of them are off, not all of them, and a majority of them, even though they may not be exactly to the penny because they're annualized, they are on a consistent basis still showing a progression or a degression, of the earnings, which is really what's important when you're looking at a calendar spread. So in this regards, this is strictly for Bob or anybody else who wants it. I did find one candidate out of all the 42. The rest I really didn't. And again, that's why I'm going to look for alternative sources for finding calendar spreads. I'm going to do it on the Thinkorswim platform under scans. I'm going to start spending some more time on scanning the market for specific studies that I'm going to add, and they're pretty much going to be the same thing as what Best Choice is showing, and Thinkorswim has that ability to do it, but a little bit more refined. So that's going to be my alternative choice of finding calendars. So the one I did find is BBY. Best Buy. On a yearly basis, they have earnings exceeding price growth here on the right by nearly 100%. That's the first step in seeing if it's a good candidate, is earnings are just screaming very, very high. Next is to find out what the pricing is. And what we're doing is we're selling the front month volatility versus buying time. That's all you're doing. Is when you buy the time, you're selling volatility. And I'm going to talk more about that today, because I spent a bunch of time learning about that more in depth, and show you guys some other techniques that you can use or strategies, and as far as earnings trades, directional trades, and so forth, where we're mitigating our risk. I mean, how many people who are listening right now have lost money on an earnings trade? Type in yes or no. Yes, you've lost money. No, you haven't lost money. No would be no, I haven't. Yes, I would be. Certainly appreciate people typing in. All right, here let me refine the question. How many of us that trade earnings, because it's kind of, we love and enjoy that big pop. The problem with it is the market makers understand this as well. And remember, there are three ingredients that go into an earnings trade. There is the EPS, the earnings per share, that analysts in the company, analysts feel based on their financials and their projections what their earnings per share should be. And then there's the revenue, meaning their sales, what they expect the sales of the company to do. And the last is the conference call, and kind of the gotcha, as I would call it. And that's the where the CFO, COO, CEO talks about forward guidance. And forward guidance, a lot of times can catch you. I've seen it so many times happen where a company beats earnings, revenue is great, but all of a sudden their forward guidance isn't what analysts expect, and people just tank the stock. So with all that said, and we all know this, I don't mean to beat a dead horse, but it's important that we also start perhaps switching our way of thinking to be more consistent in making money. And I think that's a goal for all of us. Am I right or wrong by saying that? Feel free to type in that I'm wrong or I'm right. Excuse me. I have been fighting a cold since last Wednesday. So I'm going to apologize in advance if suddenly I cover up the mic, because I don't want to cough in your guys' ears. And hopefully my voice will last here. I did lose it on Friday completely. All right. So with this said, you can go to the option chain. This is the calendar spread. Unfortunately, Bob, the problem with trying to find candidates right now is we're so close to the monthly expiration that you really want about 3 weeks of time value on the front month to be able to capture as much of the time decay as possible. And you always want to be at a 50-50 probability. That's why you always want to sell and buy at the money. Because some people say, well, why can't I get more or pay less? Because then you're skewing the probabilities by being directional. The whole point of a calendar spread and taking advantage of time value is to be as neutral as possible and have a 50-50 probability in either direction. So with that said in mind, you can do this, but you'd have to execute it like first thing in the morning because this thing will expire this Friday. So you want to be able to capture it. There's huge annualized premium on this front month with only 5 days. Then you go out to a June expiration, giving yourself 6 months time because you're expecting this pattern of growth in the background to continue. You know, that's the whole premise. You're trying to sell, you're selling calls when it's at the top of the band. So somebody is buying that from you. You know, you're being a seller. You're saying to the people, hey, you know, I'll sell this to you. That person who's buying it is thinking it's going to go up. But if we look at now June, it's only a 25% annualized premium. So the spread between the 25 and the 354 is what you're going to be collecting. And then you'll simply roll this before expiration Friday into a February, which I believe would be, I don't know, it's one of these three. That's why I don't like using this. I don't know which one's the weekly. I would think it's this one here. So you would roll it into that, which, you know, still you got 59 here. Now this is going to go up. Premium is going to go up. If this stock continues to go up, so will that annualized. So you're going to roll that, and you're going to find that it's pretty inexpensive. By the way, I changed this, Bob, for your own edification to 4 strikes. That way it's really, because all we're looking at is at the money. So here's the monthly expiration for January. Here it is for June. So we are going to buy that. You hold your control key down. You see that these light up. And then we're going to sell this. So it creates a debit of $2.03. When I did this yesterday, it was $1.97. Reason it's gone up a little bit in a down market. What does that tell you? A stock that is contrarian to the direction of the market means it's got a lot of strength. All right, so that's the one spread that I found. Okay, now let's go on to some more of the earnings this week. I did pull the earnings from FinViz. I copied them. I looked at all of them for this week. And there's a lot of financials coming out, folks. Now, I didn't have enough time to go through everything, so I apologize in advance. One of the companies I do love is CSX. It's a railroad company, but they do a lot of transport of coal. Coal's gotten beat up. They are way oversold. Linear regression is pointing upwards, which is, these are very powerful tools. I use them in all of my charting. Let's go to a 1 year. See, unfortunately, earnings are kind of You can always look at earnings at this icon, view data. Excuse me. They have consistent earnings, though. I think that's what's key. So I did not look at what the pricing is, but we can look at that real quick. Expand this out to go out a little bit more out of the money. We'd be looking at a February. Oh, let's take a look at when his earnings coming out. Make sure we'll be able to take advantage of it so it's not tomorrow morning. Yeah, there it is. So is it tomorrow morning? No, it's after market. Okay. So it has an opportunity to come in. Now, on these other alternative strategies I'm going to share with you today, all of them you come in the day before. If it's like in the morning, day before, or even if it's in the after market, you come in the day before. You try to reduce as much change in premium as possible, because all of the alternative strategies is you're collecting money. You're taking in a credit. And I'll explain how that works in a second. All right, so we have this tomorrow morning, or yesterday, or tomorrow after market, so that's good. CSX. Let's see what it does seasonally. See if there's some merit. Maybe that's the reason I didn't like it. Yeah, that's the reason I didn't list it. And that's a real easy way to go through any list of stocks. I always like to start with the seasonal because this tells me what historically I can expect. Is it even worth me taking the next step of analyzing it? Meaning, where is the stock sitting at right now? Is it overbought or is it sold? Is linear regression pointing up? So forth and so on. So you can go through a list pretty easily. And just visually, if you see a lot of lines below and above the composite, you don't even have to take your mouse and hover over. You generally can see that there's not a lot of consistency from a directional standpoint in regards to earnings. So that's the reason I didn't list it. One I did, though, is Citigroup. This, using, I think it's, best profit per trade, is an 8 out of 9 year winner with an average 10% move. So that's where I start. From there, then I'll go and see, what kind of action is there as far as volume. Generally, I like to trade options where there's at least 1,000 options per strike level. A little tidbit that you guys may not know about me. That's generally what I'll do. I really will stay away from anything that's not at least that liquid. So I like to have at least 1,000 per strike price. All right, so there's a lot of action here on the spot month. And you see a lot of short interest, 86,000 contracts at the 50. 10.3% potential drop. Now, here's another way, folks, I want you to be able to use tools that I think most of you have, Thinkorswim, as a platform. When you're looking at an earnings trade and you're saying, well, what's the average move I expect? The tool we have and we've always used is this tool. This is the average move, one of the best tools that we can have to project what we expect that underlying stock to do. How much is it going to move? You take that average percent move, you apply it to the stock price to give you a target. And then sometimes I'll use Fibonacci for extensions of those to see if it goes beyond that or below that. The other technique, though, that's already built into Thinkorswim that all of you should be using is when you close these, the option chain, and you look off to the right, you will see the percentages, and I'll explain what these percentages mean. These percentages are actually what's called IV rank. And I'm going to, for those of you that are interested, I spent about 3 hours this weekend finding a ThinkScript that is not in the studies. And I found it, and I'll be glad to email it to anybody to add this to your charts. And it's a wonderful tool to have. It shows the IV rank. Let's go back to what we were looking at, which was C. And its IV rank actually is 84.2. What's the difference between IV rank and implied volatility? IV rank takes a look back over the last 252 days and says between the lowest the IV's ever been to the highest it's ever been, where is it currently sitting at from a scale of 1 to 100? Does everybody understand what I just said? It's very important to know. A lot of people over the years have asked me, how do you determine volatility? We've seen volatility crush from earnings, and all of this is going to tie together. That's going to make a lot of sense to you guys, and I think you're going to have a really big light bulb turn on and go, wow, why didn't I start doing this before? So even though implied volatility, the old method we used to use is what is the current implied volatility versus historical volatility. And I showed people, where you can go from a on the net site or on the net. There's a place called ivolatility.com. You can register for free. Why did it do that? There's mine. That's what it should have done. And so when you log in, you'll look off to the left and it'll say historical option data. That's where you can click on. This is different. This is all new. Interesting. I'm sorry, click on basic options, not historical options data. Click on basic options. And then you will see these graphs pull up. And then simply, we're looking at Citigroup. So I'm going to type in C. And it'll give you all the statistics. Over a 52-week, here's a 52-week high, 52-week low. So, for example, this statistic, the lowest it's ever been to the highest it's ever been, when this is looking at the current, that rank is saying between the lowest, 5.73, to the highest of 36.83, where is it currently sitting at? And it's at the 84.2, which means there's a lot of volatility, folks. And this is typically what you're going to see probably 95, 98% of the time before what's called a binary event, or what we like to call an earnings trade. And it's an unknown, folks. Let's face it. We all know that. We don't know if it's going to go up, it's going to pop up or pop down. We try to stack those odds and probability based on what we have from seasonality, but it doesn't always come out right. So how can we increase the odds, still make money, but also reduce our risk? Does all that make sense? Perhaps not get the big pop and the huge return, but be more consistent in how we go about making that. And that's kind of where my head is at. So we see it's way oversold. We see linear regression going up. We see the unknown event, but we also see a lot of volatility. Okay, so if you wanted to just do a directional trade and believe that the stock is going to continue to go down, let's go to a longer time frame. Let's go to 1 year. So 1 year changes the picture, doesn't it? See, right now it's, the low is at $46.10. The mean is at 53.14. Now that's based on my linear regression setup of a 90-degree width. Remember, I went through that standard deviation versus, I showed that that chart. So with best choice now, if we go to a year, it's a little bit lower. It's at let's get rid of the earnings. You can see it's the 13.6 extreme because these, as you see, are one standard deviation. I tend to go out further to see, well, how much further can that potentially go down before it's going to pop up? And that's why I use the 90%. Or did I have to make sure I got the right stock, don't I? Yes, I do. Okay. All right. So what I would do if I would do it directionally is I'd buy that 50 put for 62 cents. That's very cheap, inexpensive premium, not risking a lot, $62 per contract. It's very close to the current stock price, so maybe I'm paying about a 1.2, 1.3% premium. In other words, it's cheap. The cheaper you pay, the higher your ROI is going to be, as long as you have a decent delta. Remember, the delta has to be over 20 minimum. The higher the delta, the better, and the closer to the money you are, the better. So an alternative strategy now, Sorry, I've got to move some things around on my other screen here. Let me bring up my cheat sheet. I have a PDF file if somebody is interested in. It's from a company that I joined that I really like, their educational tools. It's called the Ultimate Strategy Guide, which gives you the various strategies to use based on your, I don't want to say feeling, but what bias you have directionally and where's the IV sitting at. But all of these strategies, I will tell you, have one thing in common. Where's my other cheat sheet? There it is. Let me kind of read from this so this will make sense to you guys. I think it says the first big concept you need to understand about earnings is that in general a stock's implied volatility will rise in heads of its earnings, and that's, we all know that. Your IV, implied volatility, goes up, which means the cost of the options go up. It's due to an unknown event, or what's called a binary event, i.e. earnings. Why is earnings called a binary event? Binary means two. Well, there's only two things that can happen. It's going to go up or it's going to go down. That's why it's called a binary event. It almost never, that I've ever seen, stays flat. Because there's either euphoria or there's super negativity. So, some stocks have more volatility than others, but because there's a lot of uncertainty, what happens around the one-time event, what typically happens is that volatility is sucked out of that premium, and if you're too far out of the money, what will happen is the true cost of that option will collapse. And if you don't pierce through, for example, I'm talking about C right now. You know, if you buy C at 62 cents for the 50, that's only 38 cents away. We're banking on this directionally for it to go down. There's other tools you can use to help you give the confidence that is going to be the direction besides just from a seasonality standpoint, even though this is a great, phenomenal tool. You know, you could go to other websites to see what analysts think. Earnings Whisperer is one. Like I was looking at Morgan Stanley, and that's another, you know, one that I was thinking of looking at, but I don't like what analysts are saying. It's contrary to what seasonality, and it's kind of a mixed bag. So type in C, hit enter, click on analysts. A lot of analysts are very, very strong. There's 14 buys, 6 holds. So, you know, you got to weigh this with a grain of salt. Where are you going to put your weight on as far as what's going to sway you in a decision of where your bias of direction is? For now, let's just stick with seasonality. Hold on a second. Excuse me. Okay. So if you buy it just directionally, it has to go through that strike price because you're 62 cents at a 33.6 volatility, but we know this isn't the figure you should look at. This is the figure, the rank. Okay, another way that you can see this, even if I don't email you this script, so you can have this stuff on your charts automatically. By the way, I also threw on one standard deviation. In other words, in one standard deviation, that's what these are. This is one standard deviation from the mean. This is saying it's plus or minus $4.59. So it could go up or down within a month $4.59 based on its current IV and based on the rank from 1 to 100 in the last 252 days. Where does that current IV stand? I hope this is not getting too complicated, but this is wonderful stuff. Bottom line is, if you don't have this and you don't get it, you can get it automatically right here, today's option statistics. And as you see, the implied volatility 31.53 is exactly what this is. Difference is this is just put right on the chart, so you don't have to flip. The current IV, they call it percentile. The script that I found calls it rank. And this makes more sense because if you think about it, even in best choice, when you add something and you create something, you have on the right side where the stock, where all of this ranks, 0 to 100. Where is this rank, you see? It's at the 53. This is in the mean. 102,910 volume happens to be right in the middle from a scale of 0 to 100. So even Pete in his wisdom, when he created Best Choice as a screener, used this. So I prefer to have rank. I like rank versus current percentile. But either way, you can see it's giving you the same statistic. So even if you don't get the script, you should be looking at this, because this will tell you, is there a lot of volatility? If there is a lot of volatility, you know there's going to be volatility crush, and it's going to be heavy. That's today's option statistic. Now, we can go back and open up January, and let's open up February. You can just from implied volatility, 33.74 to 26. The difference between that. It doesn't seem like a lot, and that's why I prefer, now that I went out there to find this tool, this is so much more helpful and so critical. Because if you find stuff like this, folks, you can sell it and collect money, and it's a very high probability trade. And that's the situation you want to be in. You want to be in high probability trades on a consistent basis, putting money in your pocket. I hope this all makes sense to you guys. So rather than, really do what we've been doing a lot, which really is my eyes, again, it was more of an epiphany than it was new knowledge, because I knew there's more sellers than there are buyers. If you look at a ton of professional traders out there, they're selling premium. They're not directional. They're taking advantage of us in all reality. Because remember, you sell something, somebody's buying it. And as long as you're directionally correct, you still have to be directionally correct. Don't get me wrong. But there's a way to mitigate the risk. Okay? So there are 3 strategies for earnings that you can use to reduce the risk and take advantage of the volatility. In any case, the thing that we want to be doing is being net sellers. That's the key thing is we want to be net sellers. Now, one of the strategies, and you've heard Sonny say this, only in his great wisdom, I don't think he really looked at the flip side of it, and that was a straddle. He talked about a straddle. What is a straddle? It means you're just like a horse. Think of this middle part as a horse, and you're putting your foot on one side and on the other. And so that way, whichever way it tilts, your foot will go this way or your foot will go this way. So you're taking advantage of being neutral. The problem with a straddle that way is the stock has to move heavily in a particular direction, and in order for you to be profitable. I think a better way to do this is to sell a strangle, not a straddle, but a strangle. A strangle does one strike out of the money, one strike in the money, as an example. Now, before I show you this, folks, I'm going to forewarn you. There is more of, it's a much higher statistically probability trade to make money on, but it's not a defined risk. Okay? I'm going to show you a scenario to have a defined risk, but there are people that make killings on this. So it doesn't matter where you're on, be the call side or the bid side or the put side. It doesn't matter if you put your cursor on the bid or the ask. You can simply, let's say we just put it on the ask. You're going to right click, go to sell, and go to a strangle. Now, you always want to be selling out of the money call and out of the money put. Okay? Now, when you do toss, it just does one strike out of the money. So you're collecting $1.36. You can do it yourself. Now, I've defaulted to 10 contracts, so I didn't change that. I should have changed it to 1. You're going to pocket $136 on this trade. Okay? So if this was just one contract, I don't know what you guys pay for commissions. I pay $3 for a round turn. So going in and going out, right, that's going to be 6 and 6 because I'm buying one and selling one. So this is one contract. That's 2, right? So there's 2 contracts. 2 times 3 is 6. But then I also got to unwind it. So my total commission in this is $12 if I was just one contract. If it was 10 contracts, it'd be $120. If it's $120, of course, if it's 10 contracts, it's not $136 I'm pocketing. It's $1,360. But do you see this? Maximum loss is infinite. So that's why it's an undefined risk. It's a very high probable trade, though. You make a lot of money on this. I'm going to give you guys an example. Who traded Apollo or MU last week? Micron or Apollo? They were both losers on earnings. Can I get a show of hands, a yes or a no? One yes, 2 yes, 3 yes. Okay, all right. So let me show you on either one. Let's go to MU as an example. MU had its earnings, what day? The 6th after market. So let's say you came in on the 5th or the 6th because we had the webinar here. You wouldn't have known about it until the 6th. Let's say you came in on the 6th. Maybe you would have, obviously. You could have traded it without me. But okay, we saw tons of volume on the spot month. Right. Oh, all of these strategies, by the way, minimum of 30 days to 60 days. Okay? You're never going to be buying the spot month. You're always going to be buying 30 to 60 days out. So you would have not looked at January. You would have looked at February. Okay, now I think I put the 34 as a probable, didn't I? I don't remember what it was. Okay, so let's do this. Let's sell a strangle. Now that's a huge credit, right? The reason it is because toss defaultly will buy whatever or call that you put your cursor on, and it's going to sell one underneath. So you're actually buying in the money or selling in the money put. You don't want to do that. So what you're going to do is just click that as if you're buying it. And this is 1, 2. You want to be equal distance away from at the money. Let me repeat that. You want to be equal distance away on both sides, what you're buying and selling, from at the money. At the money currently is 32. So if I bought that, that's 1, 2 strikes out. I need to go 1, 2 strikes out on the put side. Okay, now I bought the call. I'm going to sell the put. I'm going to put my cursor on the put, and then I'm going to hold down the control key and click it. Oops, that didn't work out. I'm sorry. You're selling both. That's what I meant to. That was what I was doing wrong. Okay, so put your cursor on the sell, the bid side. Left click it once. Hold the control key. Click the bid side on the put side, and now you create a strangle, and you're getting $1.46 credit that you're pocketing. Okay. Oops, we didn't do this under Analyze. I'm sorry, that's what I wanted to do it under. My bad. Let's go back to the 6th. And let's go to February. And let's go to the 34s and sell that. And since 33 is at the money, so we're going to go 1 strike out to the 32s and sell that. Now, that's a huge credit, isn't it? It's $310.05. Let's call it 310. Okay, let's just wind it forward. That's 1 day, folks. Now, granted, that's 10 contracts. You know, we could let's reduce it to, I don't know, 5. So really, how much, in other words, okay, keep in mind, doing this strategy, you have to have enough cash in your account to cover the margin. Okay? In other words, if it goes against you and you have to deliver at expiration, the brokerage firm will require a certain amount of dollars in your account as a margin. Okay? Now, these strategies are very, very effective and highly, highly probable. So what happened to MU? It closed at $32.87. Earnings came out after market on the 6th. The next day, the 7th, it didn't go up, it went down. But we made money. Right? $317 on 5 contracts. Okay? Now you could wind it out a little bit further and say what happened the next day. The 8th, it went to 432. The 9th, 482. I don't know what day that is. That's the 9th. What would it be today? Well, 407. The whole key is this is a way to make money and protect yourself and, well, not protect yourself, but it's a way that's a very high probable strategy for earnings trade. Selling a strangle. And I've just shown you evidence of that with MU that a lot of us lost money on last week. Let's look at Apollo. Now, MU only went down 77 cents, so it didn't move big, did it? Let's see if we did the same strategy for Apollo. You know, when did it come out with earnings? Oops. Came out the 8th before market, so we would have had to come in on the 7th. This is under trade. Let's go under analyze. Okay, again, February. Wow, the stock is real close. Yeah, okay. Earnings came out before market. All right. So again, you want to sell out of the money calls and out of the money puts. Now you say, well, which strike level do I choose though, Gary? It's already built in for you folks right here. If you're doing February, can everybody see this number over here on the right? $4.06 plus or minus $4.06. You see that? So that's already telling you, based on the Greeks and the options and the chains and the market makers and all this stuff that frankly I don't understand. Excuse me, because it's already built in. Okay? That's all I need to know. And that's what's important to me. I don't need to understand how do they actually derive that. Now, I think with best choice, of course, our bias for Apollo directionally, well, not so good. Let's see. Well, see, starting from the 21st to the 14th, yeah, 8 out of 9 years. But that's starting from the 21st. So in either case, from a seasonality standpoint, we expected a pop. Well, if we don't, again, we don't know with earnings, because if we did that, we expected it to go long, and we bought out of the money calls directionally, we lost money. We've all done this. So what if we would have said, let me try another strategy. Let me buy, okay, so I know $4 above the current strike, right? Or below the current strike. So what am I going to do? I'm going to go to the 35s. Okay, I'm going to sell that 35. I'm going to go 4 strikes underneath the current at the money. 1, 2, 3, 4. I'm going to sell the 28s. I'm going to pocket $1.23. Let's see what happens next day. No, lost money. Let's try it again. Lost more money. Today, lost even more. That strategy did not work, going that far out of the money. Now, let's say we did closer to the money. And let's say we just sold at the money. I'm sorry, 1 strike out of the money. 1 strike out of the money and 1 strike out of the money. We would have pocketed, let's call it $2.80. What happens the next day? We lose money. So we know strangles don't work. Okay. So what's another strategy? One of the things that if you guys aren't doing is verticals, right? A vertical limits your risk. You still have to be directionally right though. Okay. And if we were directionally bullish on this and we said, well, okay, let me buy at the money, and let's see what would be 2 strikes out. And what's the cost? 97 cents. Not real crazy about that, because that only gives me a $1.04 in potential profit. That's the difference. Actually, it's only $1 or $2, yeah, between 31 and 32. I don't like that. So let's see if I can get some more spread on this. Buy at the money. And then let's see if we go out to a 36. Let's try 35. Okay, $1.60 on a $4 spread. A little bit better. That leaves me $2.40 potentially I could make, because there's $4. That's $400. And if I paid $1.60, it's the difference between $400 and $1.60, which is $240 I could make. But that doesn't include commission. And you do 10 contracts, well, you're talking about at least $120 you've got to subtract out of that. So again, I have to be right, don't I? And here I lost money because I wasn't right in direction. Even though historically everything else, the tool we use says, let's go this way. So how can I perhaps say, well, what if I bought a vertical on this side and bought a vertical on this side. Now I'm covering both my bases, aren't I? Let's see how that would work. Well, that's called an iron condor, but we're going to sell it instead of buy it. We're going to get paid. Let's see what happens. Hello, we made money. Didn't make a lot, right? But we made money. This is the last strategy I wanted to share with you, is selling an iron condor. Now, I went out of the money. Now, once again, I could have said, okay, it's $4 up or down. So $4 from at the money is 32. $4 would put it to 36. Would I made more money if I did the iron condor at the 36? Again, I'm doing the default of what TOS is doing, because it's also buying and selling puts at the same time, but they're doing it in the money. That's why I'm getting a decent credit. So even if I went out to that 36 and I bought the 36 or sold the 36 and bought, again, this is a vertical. It's all it is a vertical. It's the same thing. Okay? Same thing, but in reverse, because I'm selling it instead of buying it. Remember, when you do a vertical, it's a very simple trade. You buy at the money, and whatever strike level you go, usually this isn't $5. Let's just say it was $5 to 36. Then you sell. That creates a vertical. Okay, but you have to be directionally correct. And the stock has to move beyond your price that you sold. Doesn't have to. I mean, if you got real close, I'd still make money. Ideally, it would close beyond what I sold. So it has to close beyond that 36. But either way, folks, I have to be directionally right in order for this to work. But as you see, I bought closer to the money and I sold further away from the money. That's buying a vertical. Okay, but when you sell an iron condor, it's doing the reverse. I'm selling closer to the money and I'm buying further away from the money. So it's the opposite of that. And again, I could spread these out and still create the same thing. I'm just showing you guys a limited risk. This does not require the margin account. This also defines your risk rather than that strangle. Strangle you made more money on, but you had undefined risk. Selling an iron condor, you have a defined risk but less profit. One of the reasons is you're buying more contracts too. So you have to weigh the cost of commissions, cost of profit, credit, and everything else. Okay? So let's take a look at an example. Now, does this make sense? Okay? See, if I went that far out on the 8th, I lost money. So I prefer to be closer in the money when I do the iron condors. Oops. Let's do this. One strike at least. Okay, so I pocket 80 cents, 81 cents. Why am I losing money on this? What strike level did I use last time? Do you guys remember? Oh, it was the 30. Was it the 30? No, it was the 35 that I did. That's right. That's right, because I was using the $4 spread difference. Yeah, there it is. So again, there's your technique. I went $31. I rounded down. I always round down. Even though this says I'm above the 50-cent mark, I should be rounding up. That's why at the money is 32. I'm still a conservative trader, so I'm going to round down. This says a $4 move, which would put me at the 36, As you saw at the 36, if I did a condor, I sold it, I lost money. The 35, I made money. So you would have taken your money off the table the next day, literally the next day, because otherwise you're losing money. Okay, so let's take a look at Citigroup, which is just one that's on our table. It's got earnings coming up this week. Let's see, when is earnings on it? The 15th before market. Okay, this Thursday before market. So you'd be looking at the 14th. So hypothetically, and this is on the trade tab, so if we said, okay, how much do we expect this thing to go? There's another $4, right? Now what's interesting is, okay, Citi's at $4, right? So it's at $50.38 today. From a seasonality standpoint, Citi is going to go down an average 10.25%. Okay, so if we took our calculator and went 1 minus 1.025, oops, let's clear that, 1 minus 0.1025, that's 10.25% converted to a decimal. That gives you your factor. You multiply your factor times the closing price to give you your target, times $50.38. So my target is $45.21. Okay. Now, this is using best choices formula of historical average move. Let's just use what TOS provides. TOS is saying it's $4.05. So remember this number, folks, 45.21. $50.38 minus 4.053. Well, pretty close, right? It's giving you the close estimate. So if we did that and said, all right, we could then sell an iron condor. You see there's a lot. I like that 1,000 open interest, right? The 50 is below. So if I sold this iron condor, I'd pocket $1.46 or $146 per contract. Now I want to show you what your risk reward is. Well, my max profit, well, this is 10 contracts, $1,480. My max loss is $35.40. I don't like that. There's more risk than there is reward, right? So we need to go out a little bit. Pocket $1.89. I still have a higher loss ratio than I do a profit ratio. But it's a defined risk versus a totally undefined risk. Again, all you're doing is buying a vertical on both, selling verticals on both sides. It's a very high probability trade. Once again, it's a way to mitigate your losses. And the key is that we always want to be net sellers. That's the whole key. As long as we stick to selling options with high implied volatility, that's the key. And that's what we're talking about, the run up to an unknown event, a binary event, which is an earnings event, right? We know that they're pricing these options more expensive than what they would be based on an unknown event, right? And again, if you don't have the Think script, you can see that currently The implied volatility is at the 84% rank in the last 352 days. I'm sorry, 252 days. It's saying that this is at the 84th rank of as where the lowest to the highest it's ever been. Pretty high IV. So we want to always be, selling high implied volatility, and we're going to be much better off than just buying options directly, around the earnings time. Gives us a lot more opportunity to make money. Okay, let me give you one other one. I spent a lot of time on this. Goldman Sachs is looks like a seasonal pretty good one. It's an 80% probability, but it's a big mover. That's using best rating. I think best profit's the same thing. No, it's a 70% probability. So if you have to use the best rating because it gives you the best window of opportunity. And it is starting around the 19th, which means it's after earnings because earnings is coming out Friday before market. So you'd be looking to come in on this play around the 15th. And what I had put for this is, since this is a bullish trade, okay, we can also sell an iron condor of February as one potential. Oh, for directional, just so you know, February 200s is what I'd be looking at. Be this one right here. That's based on what I expect. 7.21 average move, which is also that $13.12 at 13 to 185. That puts me at 198. But when I first did this, this was at 187.5. It went down $2.28. It could be up $2.28 tomorrow. Bottom line is it's about a $13 move. If it's sitting, tomorrow is a bullish day because today we had a bearish day and things go up and GS pulls up with the market. Well, then we'll be back at the 200 mark. So directionally at $1.12, that's really inexpensive, about 0.8% premium. Now for Condor, selling it, sell again, since I expect that 200, I'm going to use the 200 as the mark of what I'm going to sell it at. It's a huge credit, $4.05. But look at that, folks. That's the risk reward that I'm looking for. What is that? That's 7 to 1? Real close to that? Or I'm sorry, about 4 to 1? So these are the odds that I look for. So, selling a 200 iron condor is great. I like that. The other would be since this is a bullet, there's two more strategies for bullish trading. One would be a bull call spread. Basically, it's a vertical, right? And you simply, since this is $5 increments, right-click, buy a vertical. You're going to spend $2.53. Oops. That's buying the 185. Oh, yeah, that's why it's 253. When I did it earlier at the money, was this. That's why I have down one. I was wondering why my pricing was so off. So I had $1.51 because I was saying buy the 190s, sell the 195s. I would still do that, folks, because this is an earnings trade. And there's a potential of a $13 plus move on this thing. $13, even to the price it's at right now, puts the stock at 198. So your profit potential is more than double of what your risk is. Again, there's a way to, got to be directionally right with this though. Goes against you, you'll lose this money. but that's all you'll be losing is it's a defined risk to the amount that you spend. The other would be is that you do a bull put spread. Okay, sell the 175s. Okay, it's about $13 away. It's a little bit closer than that. You sell these and buy for protection because you're selling this. What if the trade goes against you? You don't want to be caught delivering it, right? So you're selling that, you're collecting premium, but you're buying the 165s for protection. So you're getting a credit of 149. This one, even though you have a lot opposite, it's if you go far enough away out of the money where the likelihood of GS collapsing, let's add some strikes to this. Unfortunately, there just isn't a lot of volume in here, so that's one of the reasons I wouldn't do a bull put spread, but a bull call spread or doing the iron condor is what I would be looking at for GS. One more short INTC. Oh, just to show you GS, because I did some work on this. You see where 61% probability extension is at on Fibonacci? Right there, 200, folks. So that's another confirmation for me if you were going to be directionally buying the 200 strike level on GS on February. Furthermore, its weight sitting at the bottom. One standard deviation, $14.27, puts me right at that 200. So Intel is another historical short. Again, the tech sector is something that we short usually this time of the year. You know, I didn't even look at Google. Oops. Yeah, Google's the other short. Just didn't have time to analyze it. Sorry, I got rid of the chat. I'm running way over here, folks. It's 5:20. Tell me, do you guys like this stuff or not? I need to have some feedback from you. I think a majority of you are still here. As a matter of fact, everybody still is. Is this stuff beneficial to you guys? I mean, you know, this is real trading. It is, there's more stuff to wrap your head around, but it's a way to make money more consistently. I know Bob likes this because this is the road that he and I both have been going down. All right, well, then I'm going to continue this path. I'll still talk about directional. I'll still try to find some trades out there. Maybe not the plethora of ones that I found before, but I'm going to try to be more selective and the ones where I find really good value in, because we don't need a lot. You don't need to trade a lot, folks, to make money. And the key is to have more consistency in your pocket. All right. I'll try to do a little bit more work and find some more. I didn't find any seasonal longs. I found that one calendar spread, found two shorts and one earnings long. I didn't necessarily, you know what? I went through all of the earnings. It's really the only one I liked was Goldman Sachs. I went through all the earnings on this. So, and seasonally, just so you know, and I'm going to wrap up with this, Gary's cycles, Gary's list. If you look at January, most stuff doesn't start happening until next week. We got the Netflix trade coming up. We got the Priceline trade coming up. Two huge earnings trades that are coming up. So we'll look at those next week, right? And then, of course, there's the Goog trade. I don't know why Goog is not on here for short. Maybe it's because, well, it should have been on here, but it's not on here. Oh, this is the company, so you know, Options Alpha, fantastic company. I got their watch list. I actually paid for it. And believe it or not, probably 85% of the stocks are the same stocks I have. But even with them, they have a few more. Their stuff doesn't start until next week. See, there's Netflix on there. They got Groupon, which is a newer company. They also got Priceline. They got LinkedIn. You got some of the high techs, First Solar, Zynga. So I think I'm just going to leave it at this without doing a lot more work. And absolutely, you're right, Woody. Netflix is one of our historical best performers, but so was Google up until 2012. So again, we can play directionally, limit what we spend on it, but let's also look at some other strategies to be able to make money on. Make sense? It does to me. All right, folks. So with that, I wish everybody good trading this week. And until next time, we will talk to you soon.